Welcome to our market update for March 2025. So after markets have delivered very strong returns over the last couple of years, coming into 2025, we've seen a massive pickup in volatility and we've seen equity markets sell off to the tune of about 10%, and that's primarily been driven by the US president's platform of tariffs and the trade war that is ensuing on the back of that, with retaliatory tariffs from trading partners. The real problem that we have with tariffs is that it's creating significant economic uncertainty, both in terms of business and consumer confidence levels or lack thereof. It's also creating problems for supply chains, for inflation pricing risk, all of which makes the job of central banks more difficult, which we'll talk a little bit more about. But it's really the uncertainty that is the main thing that markets hate the most and have trouble pricing. So I think once we get through the next few months and hopefully we see a resolution to where tariffs actually ultimately land, that is definitely going to help market confidence and business confidence going forward. Now, as I mentioned, the last couple of years have been very, very good for equity markets broadly. So it's important to put the 9 or 10% correction in context of that. The other thing that's important to note is that most years the share markets will decline by 10% within any given calendar year. And most of the time share markets finish higher than they start. So again, that's important as long-term investors, that this is just a normal part of the market dynamics that we're seeing play out. In terms of economic indicators, they are starting to deteriorate, which we'll elaborate on shortly, but it is too early to call a recession. So that is the base case for the time being. We've already talked a little bit about tariffs and we'll talk more about them shortly. President Trump historically has used these types of policies as a deal-making platform. However, there are longer-term risks showing up in the form of retaliatory tariffs from other countries imposing tariffs on the US. And this is where things get complicated, because the US could do a backflip on some of the tariffs that they've already announced, but then it also requires a backflip from their trading partners. So there's certainly more complexity to tariffs this time around as opposed to back in 2015, 2016, when Trump was last in office. As I mentioned, central banks do have less room to cut rates in a slowdown scenario if inflation reaccelerates as a result of tariffs. So that is problematic, both for valuations and economic support. We think volatility will continue in the short term, given the nature of the risks that we're talking about are ultimately guided by what Trump decides to do, and that changes on a day-to-day basis, as we've seen over the last few months. From a portfolio implications perspective, we are long-term advocates for investing in quality, whether that's quality companies or quality funds, as we think they have the characteristics to both withstand downturns, but also perform strongly during more buoyant conditions. And finally, defensive investments are really, really important, particularly in moments like these where we have more volatility in equity markets. And we're really talking about fixed income investments here predominantly, where they are a source of both portfolio ballast to stabilize portfolio values, but also to provide those steady streams of income, which is particularly important for clients that are in drawdown phases or in pension phase. So I'm not going to talk too much about the details of the tariffs that have been announced, but the slide that I've got on here is really just looking at the modus operandi of Trump, which is talk tough, make lots of big statements, put across the board tariffs on all foreign goods, for example, putting on reciprocal tariffs against other countries that have tariffs on the US, talking through different industries where he's targeting, including things like pharmaceuticals, cars, steel, aluminium. But then within some cases, within a day, walking those tariffs back flipping on previous announcement, potentially announcing exemptions on tariffs. And that all will get to play out, and we'll see that playing out over the next week or so, and coming weeks, I would expect. So the point we're making here is that it's really hard to know exactly where tariffs are going to land, but we know there will be tariffs. We just don't know the degree of and breadth of those tariffs just yet. And as I said in the introduction, the main transmission mechanism to the market volatility that we're seeing as a result of these tariffs is twofold. One, confidence, both at the consumer level and the business level. That uncertainty is basically creating a lack of confidence. We can see that on the chart on the right hand side, where the last 4 years during President Biden's term, consumer confidence has been pretty depressed as compared to the prior 4 or 5 years, with the exception of COVID, which saw a massive downturn in confidence. What we saw when Trump got into office in November was we saw a pickup in confidence. There was a releasing of animal spirits after that 3 or 4 year period of being relatively depressed. And the confidence was on the back of America First, tax cuts potentially, deregulation, more business friendly policies. However, in the last 2 months, we've seen that flip negative, primarily on the back of the uncertainty and the risks associated with tariffs. And that uncertainty is also showing up in the form of higher inflation expectations, which is the chart on the left-hand side. So those inflation expectations have picked up significantly in the last 2 months. And just to put some numbers around that, US import tariffs are basically going from below 3% to around about 9 to 10% as it stands, or as it is expected currently. And that should flow through to around about a 0.5% increase in core inflation. So prices will be higher as a result of these tariffs that are going to come through. So as I mentioned earlier, the last 24 months has really been very strong for the share market globally. And the last 12 months has also been pretty strong up until the last 2 months. So prior to February, the markets in the US were up about 25%, 23 to 25%. In Australia, they were up more than 10%. So pretty good years in the last 12 months across Aussie and international. However, with the pullback that we've seen, that's seen the 12-month returns dip down towards 10% in the US and closer to 5% in Australia. And that's on the back of earnings growth of over 10% in the US and around about 5% here in Australia. So we still see fundamental growth in the form of earnings growth. But yeah, the valuations still do look quite high, and we'll talk to that in a couple of slides' time. And if we think about regional valuations and growth metrics for a moment, I just wanted to draw attention to the fact that the US is still the most expensive equity market in the world. And that's justified through the quality of the companies there, which are very, very high, highest in the world, and also by the fact that the earnings per share growth in US companies is the highest in the world. Now, we've had to have a geopolitical risk event for markets to kind of acknowledge and deal with that expensive valuation, but that is where it stands. If we contrast that in Australia, the ASX 200, it is also an expensive equity market. Not as expensive as the US, but it is still 20% expensive. From an earnings perspective, the Aussie market's only growing at 5%. And when you compare that to everywhere else in the world, that is low. So we have had a relatively underweight position in Aussie equities for the last couple of years, and we have been leaning more and more into international equities because of that reason. And then the final point I'd make here is Europe. I just want to call out Europe because European companies are pretty high quality, not as high as the US, but they are pretty high quality, and they are growing earnings at nearly 8% per annum. And they're a lot cheaper in terms of valuation. They're only about 7 or 8% expensive relative to their own historical averages. So we think Europe is a place where we want to lean into for portfolios that don't have much European exposure. And many of those companies, as I said, they're global leaders in their industries. Companies like SAP in the software space, like ASML in the semiconductor sector, like Roche, Novo Nordisk. These are global leaders in their fields, and we think that the qualities of those companies definitely are good for long-term equity portfolios. Just a quick comment on the RBA cash rate outlook. So we've already seen one interest rate cut here in Australia this cycle, and markets are basically pricing in another 2 interest rate cuts over the next year or so. Obviously, it depends on how the unemployment picture, economic growth, and inflation play out over the next year or so. But as it stands today, that's where markets are pricing in interest rates to go forwards. And as I said, I think that the key risk factor or swing factor for where interest rates ultimately go will be inflation and the nature of the tariffs that get put through by the US and what that means for global pricing. So at this stage, that's where things are. The other thing I just wanted to draw attention to was the fact that drawdowns are normal in equity markets. So the slide that I have here just shows the intra-year drawdowns for the ASX 200 share market since 1994, and those red dots just show where those intra-year drawdowns go. So for the most part, the average is about 10%. Sometimes it's less than that, and other times it's a bit more. And from time to time, you do get pretty significant drawdowns, such as the GFC or COVID in 2020. We saw drawdowns of 47 and 37% respectively in those 2 years. But for the most part, we're seeing 5 to 15% drawdowns as being normal. And yet, most years, the share market finishes higher than it starts. So I guess there's a few points that come out of this. 1, drawdowns are normal. 2, when drawdowns happen, it's a pretty good strategy just to rebalance portfolios. Take your outperforming assets, trim those, buy those assets that have underperformed, i.e. shares. Or if you have excess cash, you can average in and add to your investments at a cheaper price. The second point I just want to make around thinking long-term versus short-term is that over the short term, equity returns vary widely. They can be negative 39% or plus 47% for large cap equities. But over the long term, as you go out 3 years, 5 years, 10 years, the range of outcomes becomes much narrower. The drawdowns become much shallower, and your confidence in those outcomes increases. So again, during times of volatility, it's important to step back, look at the big picture, look at the long term, because that's when you see that greater predictability, greater certainty in portfolio outcomes, in return outcomes, which is some, I guess, something that we can take confidence in. Now, big picture portfolio implications for volatility that we're seeing at the moment. So first point is on equities. So equities are the long-term growth engine of portfolios. They deliver that long-term capital growth through the accumulation or growth of earnings, corporate earnings. High quality companies tend to compound their earnings at higher rates, and that's why we have a preference for quality companies. In terms of geographic preferences, we do have a preference or a favouring of international equities over Australian equities, generally speaking. The main reasons for that are that the breadth of opportunities is much greater in international versus domestic, and the quality of those companies are higher. As as we define quality in terms of return on capital and reinvestment of that. And so that's where we see our preferences within equities. Defensive investments, we've been talking about these a lot over the last 12 months for good reason. Valuations in equities continued to get more expensive, and that just means the margin of safety becomes a lot lower in equities, all things equal. So when we're talking about defensives, we are talking about fixed income. We're talking about government bonds, corporate bonds, private credit predominantly. These types of investments are more capital stable than shares. They produce high levels of income and greater certainty than shares. So that's where we see those, and they provide ballast in the portfolios, as I said previously. For clients that do have a cash allocation or a cash holding as a result of either strategic or just the accumulation of income, I think when markets are down, it's a good opportunity to add to your more volatile investments as well, as we talked about with drawdowns. And yeah, in terms of asset allocation, portfolio rebalancing, these are both really, really important to making sure that portfolio outcomes are aligned with client risk profiles, so that you're not shaken off or shaken out of your risky investments at the wrong time. And we've already talked a little bit about rebalancing, which is taking advantage of lower prices to accumulate assets, which definitely is the right approach when it comes to long-term investing. So thanks for listening. Thanks for your interest. If you do have any questions, reach out to your financial advisor or contact us via our website.